Let's head now to our regular on the Bank of Canada, Ed Devlin, former head of Canadian portfolio management at PIMCO, a long-time observer of the debt market. Ed, it's always great to talk to you. TD says that Mr. Macklem and his colleagues are signalling they're going to stay in repair mode for quite a while.
I think that's spot on. I think he's in whatever it takes mode. I thought the answer to one of the last questions when they said, what's the key messages to Canadians? He said, to businesses and consumers, rates are going to be very low for very long. So go out and spend and go out and invest. And I think that's very, very true.
Did anything surprise you about his caution in predicting where the economy is going? Naturally, of course, I'm sure he'd be the first to admit he really doesn't know a lot of things here.
You know, actually, not at all. I mean, Tiff is, a pro. He's been at the bank for a very long time. I think it's pretty clear from the bank that the downside risks are greater than the upside risk. It's, the risk of us getting a vaccine in a couple of months is so much smaller than the risk that we don't get a vaccine for a couple of years and maybe we got a second wave. So there was not anything in there that really was surprising. It was very, straight down the middle of the fairway for both the Bank of Canada and for Tiff Macklem.
Now, BMO's take here is that the Bank of Canada is once again signaling that negative interest rates aren't an option being considered right now. The rates are at their lower bound, aka we think that cutting interest rates further really wouldn't do much good in terms of stimulating the economy. So, I mean, it's always hard to be absolute, but do you think Mr. Macklem is signaling, no, I'm not going to go to negative interest rates?
Absolutely. I think even Governor Polas backed off that. I was pretty unhappy when they did research a few years ago saying negative 50 basis points was the new lower bound. And I think there's all kinds of really nasty things that happen with negative interest rates. So I'm very pleased that the Bank of Canada has pulled back from that position. And yes, I think that's exactly what they're signaling.
So am I right in thinking the Bank of Canada is telling Canadians we have no plans to raise rates until at least 2023? I
would say ballpark, you're correct. I mean, I think, what he's saying is there's so much uncertainty. I'm not going to guarantee that.
Yeah.
But what I am saying is, every meeting and every time we get together, we're going to, mark the situation of market and let you know what's going on. But he cannot see a scenario right now where he would raise interest rates in the next until the end of 2022.
Right. I mean, I'm looking
here. I'm not sure he
yeah,
can't see a scenario. It's an unlikely scenario. Sorry, I apologize for that, Andrew.
Unlikely. Now, I'm looking at analysis from Capital Economics, and they think that the Bank of Canada is really warning that economic activity, and there's a risk of permanent damage, isn't going to return to normal for quite a long time.
I think that's right. And I don't think that's just Canada. I think that's, the developed world or potentially the globe. So, that's exactly right. I think what's going to be interesting now is now that interest rates are pretty well anchored at very close to zero around the world, it'll be much more interesting to see how economic fundamentals will probably be reflected in the currency markets more than in the past where they were reflected in the bond markets.
So it's looking at inflation here at 0.6% this year, evading deflation and staying below 2% right through next year and 2022. The gold bugs are apparently betting on inflation, but the Bank of Canada doesn't seem to think so.
Yeah, the bank is saying they don't believe that. And I thought this new adjusted inflation measure was a smart thing for them to do because clearly, consumption patterns have changed. And what they're going to do is try to reflect that because, the CPI is the target, but it's not like a holy grail that they chase it relentlessly no matter where it goes. They like to look through it.
What about the Bank of Canada buying billions of dollars of Canadian bonds every week? And of course, the Canadian government could be looking at issuing $400 billion worth of debt this year. It's amazing, isn't it, the amount of government debt that's coming on global fixed income markets right now. Will investors absorb it, do you think?
It's staggering. And I think the answer is the central banks and the governments of the world aren't willing to run the risk about whether investors will or will not show up to buy. And I think that's a subtle difference between what Polas was saying about intervening and buying lots of bonds to make sure markets function versus a quantitative easing approach that Tiff just talked about, which was saying not only do we want markets to function, but we want rates to stay low, and we are going to go intervene in the market and keep rates low, which basically means we really don't care whether investors show up to play or not. We will show up to play, and we will make sure these interest rates stay low. And I think that's one of the reasons you're seeing a rise in risk markets around the world as investors say, fine, you take this pretty unattractive asset, i.e. government bonds, and we'll go do something else with it, whether that's buying equities or corporate bonds or something else.
Now, our economy in Canada shrank at 8%, an 8% pace in the first 3 months of the year. And of course, the lockdown was only there for a part of that. Bank of Canada is looking for a decline of about that, 7.8% this year, and only a partial rebound next year. So this GDP contraction is pretty stunning.
Yeah, I mean, what caught my eye is that under the central, it's not even a projection, right? Just a central scenario that, by the end of 2022, we'll be probably in that central scenario 4% lower in GDP than we otherwise would have been if there was no COVID and we just kept growing at the previous growth rate. That's huge.
Ed, it is huge, Ed. Let's leave you there with the final word there. Always great talking to you. Thanks very much indeed. Ed Devlin joined us there, and Ed is former head of Canadian portfolio management at PIMCO.